All right, friends, we have stumbled upon a great course, especially for those that are new to trading and investing with indicators, trying to figure out what is that special indicator that one can grasp early on and use throughout their entire investing and trading journey. And that particular course lands squarely on the moving average. As a matter of fact, whether you're a beginner or whether you're an avid trader, moving averages are an essential part of determining what's going on in the market, how is it trending, what are some of the signals being put out by these simplistic yet so important indicators. What we're going to do first, we're going to identify what a moving average actually is, what are some of the pros in using them, and what are some of the cons or negative aspects, and how moving averages can maybe trip up a few individuals if they're not using them in conjunction with other indicators, oscillators, and tools that you will learn throughout this coursework. First and foremost, we'll go to our wonderful buddies at Investopedia. We're going to start out there and we're going to read the definition of what a moving average really is, right? So a moving average, as it were, are a staple of technical analysis because they help traders determine what is happening in the market by smoothing out price data in action and filtering out a lot of the short-term volatility and noise. And that's really one of the main essences of what a moving average will do. Traders use them to determine if a market is trending up or down, and if it is trending, as a dynamic support and resistance level. A lot of times you will see me refer back to moving averages along with other areas of support and areas of confluence on a chart, whether it be a crypto lesson, whether it be a lesson like a weekly wrap. But moving averages have to be a part of that equation because, as many have said, and we will talk about this here in an example in a moment, bulls tend to live above the 200 period moving average. Bears tend to live below the 200 period moving average. Now, many traders will use these MAs as the basis of trend following trading system. A lot of these trend followers or longer term investors are going to love the moving average because it helps them sleep at night, get the meat of the move, and still incorporate an element of risk management if there's a warning signal that should occur or arise within a moving average ribbon. And so the other issue is it does provide shorter term moving average crosses. We're going to talk about notably the death cross and the golden cross, as it were, here in a second, over a longer term average taken as an entry signal. So yes, moving averages can trigger an entry signal and an exit signal if used. Now here's the pros. Obviously, one of the big ones is it's a great identifier at showing you as the trend up or showing you if the trend is down. It's a dynamic support and resistance level. It helps reduce a lot of that market noise with a lot of intraday or intra-week volatility. It does give you some trade signals that are generated from crosses that are either death crosses or golden crosses, which we'll refer to in a moment. It works across different time frames, but I will interject here with their pro. I highly encourage you to only use the daily and weekly time frame for your moving average ribbon. Anything greater than weekly is going to distort the purpose of the actual indicator, and it will give you signals way too late on entries and exits, and you'll end up losing a lot more than you make. And the other thing that's really critical, and we know this at Seventh Key, is that they can be used with other indicators. As a matter of fact, we're using, generally speaking, on any particular lesson that I'm doing, anywhere between 2 to as many as 5 indicators at a time. And moving averages are usually a component of that mix that I have personally. As a matter of fact, it's one of the things that I keep saved in my favorites. And I also, if you look up here, I have it saved in my chart settings just by default. That's how important they are. But what are the cons, right? So the cons are they are a lagging indicator. Now you can eliminate that by using a daily MA ribbon, but the problem is they can give you false signals and whipsaws, as the third bullet point says. The other thing that's really key is they're not great when you're seeing sideways price action that we sometimes refer to in the industry as chop. As a matter of fact, you can get beaten up by trying just solely to look at the moving average ribbon to determine any type of trend if the market is listless or trendless. And lastly, it doesn't give a great deal of predictability like some other indicators will. So let's put this actual moving average to the test. And we're actually going to use a stock here in the States. We're going to use Boeing Corporation. All right. It's been in the news here recently, unfortunately, probably for not great reasons, but that's beside the point. We're not really worried about news here. We're worried about how do moving averages work effectively. So what I want to point your attention to my time frame. I am starting out always on the weekly time frame. Start high time frame first, and then after you've studied the chart on the weekly, then drill down to the daily. And what I have done for us here is I've hidden the moving average, but I'm now going to overlay it. Now note, you can adjust this moving average ribbon in your settings here in TradingView. So if you're using any type of trading software like TradingView, a lot of them will allow you to put in your 20, your 50, or your 100 or 200. But I'm going to focus on the 50 and the 200 because those are the most widely used moving averages by a lot of trend followers. And I want to focus on that, especially for any new to technical analysis. So what I want you to know first and foremost is this red line is really important because that's our 200 period moving average, whereas the white line is the 50 period moving average. The 50 period moving average is going to move quicker because it's only calculating 50 days of price action, whereas the 200 is going to lag all of the lower time frame moving averages, but the 200 being most critical because when price is above, it's considered to be in a bull market. When it is below, it is considered to be in a bear market. Now, that's good enough on its own to know, am I above a moving average or am I below it? But the really key takeaway is identifying where there's certain crosses along the way. So just going back here, maybe a decade and a half or so, I'd like to identify a bull cross. A bull cross is when you see a 50 period moving average race past its 200 moving average sibling. That is what we refer to in the technical game as the golden cross. And I'll make that a little smaller so it's not in our way, but I want you to know what you're looking at here. This would be an early indication for any wanting to long Boeing Corporation stock. This would be a great time to do it, okay? Now, equally important to the golden cross, though, is what we refer to as the bear cross or the death cross. Not exactly a great name, but it's named that because of what it implies. So on a death cross, and I'll just identify one for you here, it's where you have the faster moving average, in this case, the 50 period moving average, rolling over and crossing below the 200. And as you can see, price responded violently after that death cross occurred. As a matter of fact, if we take it just from where the cross actually happened, Boeing stock crashed by over 60%. So that's amazing. But on the flip side, for those that are looking to long a security at a certain point, you could have ridden a 570% move just by using the moving average. But herein lies the problem. Let's look at recent history. What we see is a lot of chop. I'm going to get rid of these circles because I know when I zoom in, they're going to get larger. So let's just focus on this period right here. The one thing that Investopedia actually did a great job at pointing out is this is a real problem because it can be a lagging indicator, and when price starts to move violently up and down within a range, the signal can trigger a golden cross and then a death cross very close to one another, whipsawing investors. Now, the question would be, what do you do about that, JT? It's simple. If you're still using the moving average, one thing you can do is you drill down in time. So instead of staying stuck on the weekly, we would shift over to the daily, which we're going to do that. But the other primary thing that we would do is we would use our moving average in conjunction with another oscillator of some form, be it an RSI, be it a stochastic, be it a MACD. But there's a whole host of different indicators that you're going to learn throughout this series that are going to help to give you a lot more confluence in giving you greater conviction so you can make greater calls using a whole host of different indicators, not the least of which is the moving average. The other thing about moving averages, they come in a lot of different varieties. There's weighted moving averages, there's simple moving averages, there's exponential moving averages. More times than not, I'll just use a traditional SMA. the simple moving average. But if you want to see a little bit more of a weighting placed on recent price action, you can shift to the exponential moving average, which does a little bit better job of tracking price, at least in the shorter time frame. But again, just wanted to show some of the inefficiencies before I drill down and share with you what it looks like on a daily. So let's do that. Daily's going to have a lot more whipsaws, so we can't say that's a death cross because we had multiple death crosses here. But I do want you to pay attention to the red line. The red line is really the key because that's a 200 period moving average. As a matter of fact, when Boeing was priced up here in the mid 400s, and then it lost, it had a fall from grace, as it were, got underneath the 200. Notice the slope of the moving average. It drowned out all the volatility, but it was telling you price was going to go lower. And it sure enough did, as price tried to fight back and reclaim the 200 period moving average from a period where it had actually done remarkably well, holding the 200 and even holding the 50. Once it lost it and we started to see a trendless moving average slope, meaning there's no more slope going up, it was flat. That was a warning sign into itself. And then, of course, we saw the death cross on the weekly, which this actually created a waterfall in price action where it fell by between 60 and 70%. But here recently, if you're a trend follower, this would have been tough to ride, okay? Just because you see the move going up. And yes, you could have bought here. You would have rode a pretty good ride if you got on this particular golden cross and ridden all the way up. That's 60%. But as Investopedia points out, once this golden cross became a death cross, you would have lost 20% of that move. So it's a bit lagging, right? But even following it on the daily, if you did exit your position at this point where my cursor's at, you would have still saved yourself 50%. So even in sideways price action, the daily moving average can be your best friend. My advice is that when we're doing our lessons and when you're doing your own coursework for your own investments that you're choosing to maybe invest in for a longer period of time, always incorporate the moving average. Now, whether you want to use a shorter period moving average like the 20 over the 50, or perhaps if you're more of a trend investor that are looking to ride longer trend, use your 50 and 100 or even 200 to help you smooth that out. And then, of course, as always, use it in conjunction with other indicators and oscillators, which you're going to learn more about, not only through our community, but through lessons like this and through our weekly wraps, our crypto lessons, and all the things that I use in conjunction with my own technical analysis to share with you, my friends and community members here, how to get the meat of the move, how to incorporate risk management, and how to sleep a lot better at night. So this concludes our section on the moving average. We'll probably revisit it at some point in the future because there are a lot of different nuances that I didn't discuss, including the things that I mentioned between the SMA, the EMA, and the WMA that will be important in future lessons. But for now, for any beginner, try to start out with the moving average, as it will be a great friend and a great tool in your own toolkit as you begin your trading and investing journey. That wraps up this edition of Moving Averages. Thanks for listening.